Hi, this is Jason, Chief Technical Analyst with ToroAlerts, with your weekly market recap for August 15th. We had a pretty good start to the week with most of the major indices moving to the upside, but then we started seeing some sell-off in the last few days, finishing off the week. So let's dive into the charts and take a look at what we're seeing. So starting out with the S&P 500, our SPY chart, we can see that starting about Monday, Tuesday was pretty good. We actually hit up the 200-day moving average almost to perfection, and then started selling off from there and had a pretty decent sell-off closing the week out on Friday. So things looked like they're topped out in the markets for now. So the big question is, do we start selling off rapidly and see an aggressive move to the downside, or is this going to just chop around in some sideways price action? And that'll be the question to watch over the next few weeks. So, but it's looking like we are definitely seeing some topping patterns in the markets, and the S&P 500 we talked about for the last few weeks now. That 200-day moving average would be a really key level we'd be watching for, see how it reacts off of that. So far, it's definitely sold off of that level, and my guess is that we'll probably continue to sell off from here. So definitely not looking to probably get into too many positions on the long side till we see some stabilization out of the markets. Be looking for probably some shorting opportunities as well. And so let's dive into our Nasdaq to take a look at that. Our triple Q chart, we didn't actually get all the way to the 200-day moving average in this one, but we also saw a similar rollover in price action this week, and we did see a break on this upward channel trend line that we've been looking at for quite some time, and it looks like we are heading lower on the Nasdaq as well. And then we take a look at the Dow Jones Industrial Averages. We actually got above the 200-day moving average, so things are starting to look potentially like they might be a little bullish in the Dow Jones Industrial Average. We spent about 3 days above that 200-day moving average line. We did resist off of our Fibonacci extension level, which is sitting at about 342, and then we started heading lower from there. Now we did close the week out below that 200-day moving average. So all three major indice charts look like they've at least reached a local top for now, and this could very well be the end of this nice rally we've seen over the last month or so, and we could likely be heading lower from here. So I think having some caution, and if you have been in some trades and made some nice profits, probably be a good time to potentially take some of those profits now. Moving on to the Dow Jones Transportation Index. Last week we talked about how we got above the 50-week moving average, and that being potentially a bullish signal as long as we can stay above that, but we immediately reversed off of that this last week and have now closed below the 50-week moving average, so it was not able to stay above that trend line there, and so we'll have to keep an eye and see where it goes from here, but things are looking like we've probably hit a potential top in the transports as well. And then when we take a look at our Russell 3000 chart, we were looking at that 50-week moving average as a potential top on the Russell 3000, and it looks like it did just about touch that 50-week moving average and is starting to head lower from here, and so that also is looking like we might have a local top in on the Russell 3000 as well. And then jumping over to our Russell 1000, our large caps, we did get above a Fibonacci extension level last week, and we are still above that Fibonacci extension level right now, so we'll want to watch that really closely going into the following week, see if we can hold above there. If we do see the 231.15 level hold on IWB, then that'll be, I think, fairly bullish for large caps, but my expectations are that we'll likely see that fail and probably see the large cap indice drop below that 231.15 level, and if that does happen, then I think that'll be more confirmation that this rally is likely over. And then taking a look at our Russell 2000, our small caps, similar story here. We actually got up to the 50-week moving average this week and then started to sell off from here. So unless we can see a reversal and see the small caps move to the upside, I think the bias would be that the small caps are likely heading lower from here, as well as they did just top out at that 50-week moving average. And then we take a look at our growth versus value chart. Growth has been doing really well since about middle of May of this year over value, but looks like it's slowed down over the last couple of weeks now, and we'll have to keep an eye on that and see if this is the end of the growth over value rally ending, and if this continues to head lower, then it looks like value stocks might be the better place to put your money. And we jump over to our relative rotation graph, taking a look at the last 2 trading weeks, all of our different sectors that we watch. We can take a look at the top side here and see where the winners have been over the last couple of weeks. It's definitely changed from the last previous few videos we've done, weekly recaps. for some time now. For multiple weeks, we've seen us almost everything in the green, and that's definitely starting to change. So I think that's also looking like the markets are starting to rotate as well. But in the leaderboard, we're seeing natural gas move to the upside again. It had a pretty good correction after a big rally for multiple months, and it looks like it's starting to move to the upside once again. UNG is up about 16% over the last 2 weeks. I would be cautious with the UNG fund specifically because I believe it's sitting at the top, right below a Fibonacci extension level, which I'd want to see it break that and get above that level before I'd probably put a trade on natural gas. But if we do see natural gas move to the upside higher than where it's closed over the last couple of weeks, then I think that could be a sign that natural gas is heading even further to the upside, and there might be a potential trade there. Also seeing oil and gas exploration move to the upside about 10% over the last 2 weeks. The energy sector, the XLE, up almost 9%. And so we're starting to see potentially what might be another leg in the energy rally. We'll have to keep a close eye on that. Oil, we'll get into in a minute, is still kind of sitting around in a bit of a limbo zone, but we'll keep a close eye on that and see if that energy trade ends up becoming another good place to be, especially if the rest of the markets are selling off. We can also see utilities were one of the big leaders this week, which is one of our more defensive sectors. And then at the bottom here, we saw the laggards were a couple of our ARK funds, the ARK Innovation ETF, the ARK FinTech down about 11 and 9%. Also saw biotech down about 5% this week. Cloud computing had been doing really well. That's down about 5% over the last couple weeks. We're also seeing the gold miners, silver, and gold as well, all kind of underperforming right now. So let's jump over the oil chart we talked about. We are still kind of chopping around in between these levels. We actually did break this during the week. We did break below this upward trend line, and but we did not close below that on the week, and so we're still sitting between the upper range of this bottom trend line as well as below the 50-week moving average. So we kind of want to see some sort of definitive break between those two before we kind of decide where oil's heading from here. But if we do see, as we've seen, both natural gas as well as the energy sector starting to get a little bit of momentum build up over the last couple of weeks, if I see oil break to the upside above that 50-week moving average, I'll probably be looking for potentially some energy trades to get back into, but I do want to see oil probably break above about 93 a barrel before I'm getting too excited about the energy space again. And looking at our CRB index, our commodities actually kind of killed some of the volatility we've seen over about the last 3 or 4 weeks. Much tighter range on the week, but down a little bit on the commodity space, and so we'll have to keep an eye on that and see if we continue to move to the upside after we've kind of sold off a bit and now just been chopping around. So maybe there's a potential bottom in the commodity space, or possibly it'll break lower, but I think either way we got to see either a break above, call it about 296, or a fall below about 277 before we really have a definitive direction on where commodities are going from here. And then taking a look at our consumer discretionary versus consumer staples. This chart we like to watch because consumer discretionary is a risk-on sector typically, and our consumer staples is a defensive sector. And so this chart here gives us a great relationship as to whether or not people are in a risk-on type environment. Typically when this chart's going up and to the right, the stock markets are doing well and it's a risk-on environment. We can see that we sold off since the last end of November on this chart, and that was really when the market started selling off. And so if this chart's heading down and to the right, that's definitely a warning for the markets. People are getting defensive, and we did see this week a pretty big move to the downside on indicating people are getting more defensive and buying up sectors like consumer staples. So I think that's also a bit of a cautionary note here on this chart as well. And then when we take a look at our global index minus the US, we can see that it looks like it's peaked out as well and sold off a bit, quite a bit on the week. And then when we look at it on relative terms, taking a look at emerging markets divided by the S&P 500, it's also continuing to head down lower. It is interesting that we are hitting the bottom, getting close to this trend line. So we'll have to keep an eye on that and see if it actually breaks down below that level, or if potentially it might hit that level, and then we might see a bit of a relative bounce in emerging markets potentially, as the last couple times we've hit this down channel trend line, we've seen a decent little rally, at least in the short term, on emerging markets. So we'll have to keep a close eye on that. And then look at our high yield corporate bond ETF. That's been rallying pretty aggressively since about end of June. But then this last week we had a big move to the downside on that, and it was right after the previous week where it hit that resistance at 79.50. So that's not super surprising that it kind of rolled over from that level, and we'll have to keep an eye on it, but things are looking a bit bearish for the corporate bond ETF as well. And when we look at it in relative terms, taking a look at corporate bonds divided by treasury bonds, we are still seeing that it's kind of chopping around in this range. So not a huge warning signal yet, but I think once we do see a break below that 0.73 level, that would be a potential warning sign in the markets that the markets might be selling off more aggressively. But we're still kind of chopping around on relative terms in this sideways price action for now. And then looking at the gold and silver markets, gold had a nice rally for about the last month, but sold off pretty aggressively this last week. And so we'll have to see where it goes from here. Maybe it never did fully test that 200-week moving average, so we'll have to see if it maybe heads back down to those levels, which will probably be right around 157 if it does head that way. Or we might just see a brief correction and maybe see the gold head to the upside from here. But basically, as long as it's between this 157 and probably call it 175 level, I'm not super interested in a gold trade either way. I'd want to see probably a real clear break above that 175 level on the GLD, or potentially look for a bounce off of the 200-week moving average for a potential entry point if you're looking for a gold trade. And looking at the silver markets, silver had a big rally about 3 weeks ago. Got all the way back up to the 200-week moving average, but it hit that as resistance and then started selling off. We had a pretty aggressive drop in silver. We started the week off. We finished last week at over $19 an ounce, and we closed this week at just above $17.50. So pretty aggressive sell-off in the silver markets on the week. And when we take a look at our interest rates, we see the 2-year rate sitting at about 3.3%. It's been fairly sideways for the last couple of weeks after a big rally about 3 weeks ago. And then we are seeing the 10-year move to the upside pretty aggressively this week, sitting just below 3% on this one. And we did have a pretty nice steady decline on this after it peaked in about middle of June. We're looking for that potentially to head lower, especially if we were looking for some metals trades in the gold market, as gold tends to be inversely correlated with the 10-year rates. But we did see gold have a decent little rally as the rates were going down. It looks like the rates are starting to head back up again. We are sitting at this just a little over 3% on the 10-year as potential resistance, but if we do see it break above that level, then I think we're going to continue to head higher in the 10-year from here. And then looking at our 30-year, we're sitting at about 3.215%, also sitting right below some resistance at about 3.225. So we'll have to see next week if we see a clear break above that 3.225 level, then I think that'd be bullish to the upside on the 30-year rates as well. And then taking a look at our yield curve, our 10s minus 2s, we did see a pretty big improvement on that on the week. Still sitting below the negative 0.22 level percent on our yield curve, but we did bounce and move to the upside quite a bit off of that very extreme reading where it was sitting at almost negative 0.5%. And then taking a look at our VIX, while markets look like they might be starting to roll over, we're not in panic mode yet, as the VIX is still sitting just above the 20 level. But my guess from here is that the VIX is likely going to head higher, and if we see a VIX get back up above 25 or 30, either one of those I think would tell us that the markets are starting to get a little bit more volatile and a little riskier, and I definitely think that the VIX is heading higher from here. I'd be shocked to see if it got below that 20 level again, as it looks like the markets are likely putting a top in, at least for now. And then when we look at our put call ratio, we are at elevated put buying protection once again. We're sitting above the 1 level on our put call ratio, and so that tells us people are buying a little extra protection in the markets right now, so people might already be in on this idea that the markets are potentially rolling over, which I tend to agree with, and so there is some elevated put buying protection going on in the markets currently as well. And then when we go over to our Dxy chart, we talked about the importance of the Dxy recently, specifically for the crypto markets, but also for the stock markets as well. The dollar tends to be a bearish force when it's moving to the upside for most markets, especially the crypto space, and then it tends to be a bullish indicator if we see the dollar going down for most markets. We did see this dollar starting to rise aggressively as it bounced off that 104 level. We were hoping it might correct a little bit more, I do have a bias that the dollar is likely heading higher from here, but I was hoping for maybe a little bit deeper correction before we did head higher. And if we did, I think the crypto rally would have stuck with us a little bit longer. We would have had some more crypto trades to get in. But we saw a pretty big move off of that level, which was a retracement of about 0.382 off of that last move to the upside. So it was a logical place for it to stop, and it did, and it started moving really aggressively to the upside on the DXY. And so I started taking profits on a lot of the crypto trades, and as of right now, I'm out of all of my crypto trades currently because that dollar is just very aggressively moving to the upside. And as long as we're sitting above that 107.70 level, I don't think I'll be looking for too many crypto trades for the time being, as it looks like the dollar could be even going higher from here. We closed at the last top of the DXY. As far as close wise, we're at about 108.70, but we did peak out briefly at about 109, and so it wouldn't shock me if we see the DXY get even to higher levels from there. So to keep an eye on that, but as long as the dollar is heading higher, I think it's prudent to be very cautious if you're in any crypto trades. We'll go ahead and close out the week with Bitcoin and take a look at the Bitcoin chart. We did see what looked like a potential topping pattern in Bitcoin going back to probably August 14th, August 15th, and then we started seeing a bit of a rollover. I really like trading that 21-day EMA level as potentially a warning sign, and we saw it drop below that as well as a dollar going up, and so that's when I started really ringing the register and getting out a lot of these crypto trades. Fortunately, I was in most of them early enough that we made some decent profits and had a nice little rally to trade off of, but for now I am out of all crypto trades at the moment, as it looks like it's likely heading lower. We're currently sitting at just below 21,000 on BTC currently, and we had a pretty steep sell-off in just one day. We saw a move from about 23.3 all the way down to about 21,000. So I think the bias on Bitcoin and the cryptocurrency markets in general is likely to the downside, at least for the time being. So thanks for tuning in. Make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto. And make sure to like and share the video, and we'll see you next week.